Welcome back. Let's talk business. Market snapped 3 days of losses to end in the green. Banks and NBFCs advanced while the realty sector was under pressure. Mathew with the wrap of all the market action.
Indian equity markets snapped 3 days of losses to end in the green on Tuesday. You had the Nifty 50 that gained about 0.4% or thereabouts, about 80 points to end above the 19,800 mark. Now, it was pretty broad-based, the gains today, with the broader markets keeping pace with the benchmark indices. And most of the sectoral indices also gained in trade. For example, the Nifty Bank gained about 0.4% as well. The market breadth clearly favored the advances, with about 57% of stocks gaining on the BSE. HDFC Bank as well as Reliance Industries lent quite a bit of support to the benchmark index. HDFC Bank, after its Q2 earnings, gained about 0.8%. Now, the top gainers on the Nifty 50 were the likes of BPCL as well as Power Grid, Coal India. All public sector banks in trade were buzzing, at least on the benchmark Nifty 50. And then you had a couple of life insurance companies that were also gaining in trade, the likes of SBI Life as well as HDFC Life among the top performers. Here too, the market breadth very favorable in terms of the gainers. Among the losers, though, you had Tata Motors that languished at the bottom, Larsen & Toubro, UPL, IndusInd Bank as well as TCS all lost ground. A couple of other names that I will mention. SEAT was arguably the stock of the day. It gained close to 11% at one point, but ended about 5 or 6% higher, and this is on account of quite a significant performance in the second quarter, with profit jumping quite substantially. You also had IRFC, which gained about 3.75% or thereabouts at the end, and this was on account of higher volumes and a couple of large trades. All told, though, risk assets across the board, across the world, were higher, as there are hopes with US President Joe Biden heading to Israel tomorrow that the conflict between Israel and Hamas won't spread to other geographies, and that would be critical in terms of determining the course of risk assets for the rest of the week as well.
Well, the Indian markets also bear the brunt of the ongoing Israel-Hamas war. How will the geopolitical tensions play out for the equities? Listen in to what Standard Chartered's Manpreet Gill had to say.
The geopolitical news flow, be it what's happening between Israel and Gaza, or, well, we've heard this morning that Vladimir Putin is in China and that axis with all the Russia versus the West. How big an event it is to upend the positive momentum that had come back into risk assets, particularly equities, in the last 4-5 months?
Well, indeed, I think we're living in a particularly geopolitically charged world. But I think what's important here, and indeed with every geopolitical event, is to remember that financial markets ultimately have a narrow view. So many of the events you described, of course, very significant from a political standpoint. But the question we always ask ourselves is, what's the channel back to financial markets, and how significant is it that that channel gets activated? So if I take the history of Middle East conflicts, for example, the vast majority of them over the past 5 to 6 decades had largely no impact on financial markets, including on oil prices. And the reason for that is, if you think about, conflict that involved Israel and its neighbors, for example, they didn't really, involve a significant interruption of oil supplies. Now, there were some conflicts that did, like the Gulf Wars, and we did see a reaction in markets. But for us, that's really the key. And I think if I think about some of the events you described, at the moment at least, we don't see, a significant lasting impact to markets to the oil price channel. But of course, there are several scenarios we're sort of putting around this. And I think that's, whether we escalate within those scenarios is, I think, going to be a key thing to watch.
Now, the Indian tech major Wipro will come out with its quarter 2 numbers tomorrow. The IT firm is likely to see growth falter for third straight quarter. Indian tech giants have seen delay in conversion of deals to revenue this quarter, and it is likely to be more acute for Wipro. My colleague Tushar joins in with a preview of Wipro's quarter 2 earnings.
Growth at Wipro likely faltered for a third straight quarter as a delay in conversion of deals into revenue was seen as more acute than peers. Revenue is likely to decline by 1 to 1.2% in July-September. While that matches the guidance, it's still far from the growth seen at peers. But the company is still expected to maintain its margins at about 15% and deliver $3 billion in deal wins. Still, Wipro has a few questions to answer. One, when will the conversion of deals to revenue pick up? It's not happening yet. Deal making is still robust, but revenue clearly isn't coming in. Discretionary spending is largely absent. Two, on delayed salary hikes. Wipro has already delayed salary hikes for all employees by a quarter. They will come into effect only from 1st December. But who will get how much? Will the senior level get the hikes or the rank and file? That's a crucial question to answer because of the senior level exodus that has been since CEO Thierry Delaporte took over. The exodus was stopped by the exit of CFO Jatin Dalal last quarter. Morale definitely seems low. Next, when will consulting start showing in revenue? It's been more than 2 years since Wipro acquired Capco. That hasn't materially shown in revenue. Lastly, are there any more margin levers left to leverage? The wage hikes are in, automation is in full play, utilization levels have improved as well. Until Wipro has something more up its sleeves, all options are largely exhausted.
IndusInd Bank will report its quarterly earnings tomorrow and analysts expect the private leader to report a healthy quarter. Loan growth is expected to be healthy and net interest margins stable. Himanshu joins us with the preview.
IndusInd Bank is in focus as the lender is set to report its earnings for the second quarter tomorrow. The provisional figures of the bank tell us that net advances are up 21% over the past year to 3.15 lakh crores, while total deposits are up 14% at 3.6 lakh crores. The interesting bit is that on a sequential basis, growth in advances was greater than the deposit growth. The share of CASA ratio has also declined by 300 basis points to 39.4% this time. Despite a fall in CASA ratio, most analysts expect the bank's net interest margin to remain stable on a sequential basis. If we look at the Bloomberg estimates, they suggest that the net profit is expected around 2,200 crores, which is up 23% over the past year, supported by strong loan growth and likely lower provisions, which are expected to be a tad below 1,000 crores. Margins are also expected to be down by 2 basis points over the previous quarter to 4.27% this time. On an asset quality front, analysts expect stress to moderate with no incremental pressure points. However, a key focus area this time would be on the cost of funds, the granular performance for its corporate and consumer loan book, and the loan growth, which has averaged about 4.5% over the past 2 years. The stock has also outperformed the Sensex index, which is up 13.8% year to date, while the bank's stock is up 21.4%.
Bajaj Auto is expected to report an increase in the profit of the second quarters. This despite a fall in overall sales volume. Price hikes undertaken by the company will aid in the top line growth for the quarter. Vinay joins in with the details.
The company's profit is likely to rise 17% on higher average selling prices and increased share of premium vehicles. This higher profit is coming on the back of lower sales. Remember that the company's sales fell 13% in the quarter on a higher base of last year. Last year the company's inventory was depleted because of a shortage of semiconductors and the company pushed higher vehicles to the dealer's inventory. So that was the reason for the higher base. The revenue is also likely to rise 10% because of higher selling prices and increased share of premium vehicles. Similarly, the margin is also expected to expand to over 19% compared to 17.7% last year. So the company's financials are giving a summary of lower sales but higher profit in the quarter.
And BQ Prime spoke to Seat and Yatra to assess their growth prospects this year. What will be the triggers of growth for both these companies? Those were the managements of Seat and Yatra you heard earlier. You can watch the entire conversation on bqprime.com. Catch all the action in the broader markets every day at 11 on the stocks in focus only on BQ Prime.